Looking forward to a great evening tonight, some great information. First and foremost, I want to thank SEI for bringing us on campus during this trying time. I want to personally thank Tim Gregory from SEI for that. I want to thank everybody at SEI as well for all the help they provide us with helping manage all of our client portfolios and providing us with the necessary support we need to help give each and every one of our clients, the best service we possibly can. Next, I want to take some time to introduce our panelists for this evening. First and foremost, I want to introduce Ben Ludwig. He is a managing director and senior investment consultant for City National Rochdale. Ben is most popular for his Little League World Series event, where he coached the local team and took them to well into the playoffs. Where who'd you guys lose to? I forgot.
Oregon and Louisiana.
Oregon and
You're
Louisiana.
bringing up bad memories.
But nonetheless, Ben Ludwig over here on the left. Ben joined City National Rochdale in 2014. He has over 21 years of experience, and he is primarily our number one point of contact for any of the clients that are utilizing City National Rochdale to manage a piece of their portfolio. He will be client facing. He will be an intricate part of getting to know you as a client and your specific situation, along with his counterpart, Nick Cavallaro over here, who is actually the senior I gotta get the title right here. Senior Portfolio Manager. Nick has been with City National Rochdale since 2015. Many of you have met Nick and have interactions with him. And I have nothing but positive things to say about the two of these gentlemen and the job that they've done for many of our clients. So without further ado, I'd like to give the presentation over to Ben. We will have a Q&A session in the bottom right-hand corner. If you see the Q&A little rectangle down there, if you click on there and you select put all panelists, you should be able to type in your questions and we can monitor that during the presentation. Please engage, ask questions, pick our brains. We're here to answer anything that you have. So take over.
Perfect. Well, thank you, Dean, and thanks everyone for joining us. And first, before we start, first, thank you to all of you for taking time out of your evening. Hopefully we can give you some great information on the markets and the economy here today, but also a big thank you to the Flagship financial team. Those of you that know us, this will be a little bit of a rehash, but I want to just spend 1 minute on who we are and how we work with the Flagship team. We're from City National Rochdale, which is an investment manager. And what we do is we specialize in building personalized investment portfolios for clients. But all of the work that we do is through independent financial advisors, such as the team at Flagship. Those of you that know the team at Flagship know their planning process, the care they give to clients. That planning process is the most important thing. And really, to summarize, what we try to do is give you all the intelligence from a markets, economic standpoint, research standpoint, but also build you a portfolio that's in line with your specific needs as a client. So as Dean mentioned, my job is to really do the introduction to clients, get to know clients, really start to build that strategy. And then in a few minutes, you're going to hear from Nick Cavallaro, who is actually the portfolio manager that works with the Flagship team and their clients on an ongoing basis. Before I turn it over to Nick, I really just wanted to set the stage in terms of 2021 before we talk about what we see going forward. 2021 was a very good year in the markets. You can see here on the top, we kind of break it down and take ownership of what we got right and what we got wrong from an investment strategy and research standpoint. But down on the bottom, you can see some of the performance numbers. When you look at risky assets, equity markets, which are on the left-hand side of this page, they did very well, starting with U.S. large cap leading the way. As a firm, we were overweight U.S. large caps, so that voted out very well in our client portfolios. Not all markets fared well, though. If you see the red, you can see on the equity side of the equation, emerging markets Asia was a sore spot. But aside from that, if you were in stocks last year, you did very well. When we talk about the bond side of the equation, it's a little bit different. In the low interest rate environment that we're in right now, many areas of the bond market had challenges, and you can see it noted by the red on that screen, investment grade bonds. If you were in plain vanilla bonds, treasury bonds, government bonds, very high quality bonds, you were either flat or lost money, depending on what type and what structure of bond portfolio you had. But from an investment team standpoint, we saw that, we knew the challenges of that, and we were actually overweight some of the other areas of the bond market that you could see in the green. So if you in last year in your portfolio took a little bit more risk on the credit side, you were paid off in terms of return, as you can see by some of the returns right there. So just a quick summary of last year, but from a market standpoint, in an average client portfolio, it was a very good year. Looking forward, Nick's going to talk a lot about the markets, the economic environment, and give you some great data. But I first wanted to talk about the one thing that's really on the headlines. It's COVID. It's Omicron. It's everything we're experiencing right now. We've been in this for a long time, but COVID is still one of the primary factors that will guide both the economy, the markets, and when we look at the companies that we're investing in, corporate profitability and all the other factors that are important to us. Now, what do we wanted to do here? Because we think it's our job to present the data. A lot of our clients get news from different sources, see different headlines. But when you look at the data on this slide, the data is encouraging. On the left-hand side, you see US COVID cases and hospitalizations. So the blue line is daily new cases. This data is as of the end of the year, 2021, but we just got the updated data today. It didn't make it in this slide, but it still holds. The pattern still holds. That cases, we see it in our communities, in our backyards, in our families, cases are skyrocketing. But the good news is Omicron seems to be much milder in terms of severe illness. So you can see the hospitalizations number, how it tracks, much, much lower. So that's a very good trend at this point in time. I heard a joke the other day from an immunologist that I know very, very well. And he said to me, he said, if you don't have a friend who's positive in COVID, I feel sorry for you because you don't have any friends. We all know people in our families, in our communities, and it's extremely contagious at this point in time. So the data shows that. But if you look on the right-hand side, again, to stress the important points and the positive points, the serious illness is down. So you can see when we look at the two lines on the right-hand side, you have the blue line, which is the percentage of cases that are in the ICU. And you can see coming into the fall and winter, how that line trends significantly downward. The yellow or the gold line, depending on how you see it on your screen, is hospitalization rate per new cases. Again, a nice downward trend there. So I wanted to just start with some COVID data because we're going to talk about inflation. We're going to talk about the markets. We're going to talk about corporate profitability and numerous other aspects. But how we're dealing with Omicron specifically is going to have a big impact on how our economy goes forward. Final slide I will show you is what we call our heat map here, which really just shows the severity of cases across different parts of the world. And you can see here in North America, we are towards the darker side of that scale. So again, it just speaks to the case counts are up. The biggest question and what we're seeing play out right now is can the US and other nations developed and emerging, handle the rising cases, but also balance restrictions with keeping the economy open at the same time. And we're seeing a lot of that play out in our backyards, in our states, in our country. And then we're also seeing overseas different countries taking different tactics in terms of trying to strike that balance. So that balance is going to be one of the main factors. Can we keep the economy open and moving in the right direction going forward? That will determine right down to the companies that we own in portfolios, how it impacts them going forward. So hopefully that was helpful from a COVID data standpoint. With that, I want to turn it over to Nick. Nick's going to take us through some fine points on the economy, the markets, and things that we're looking at from that standpoint.
Okay, great. Thanks, Ben. And I think that was a good jumping off point to really start with COVID because that's really one of the main drivers. When we look at on a go forward basis from an economic perspective, what do we have in front of us for 2022? It's really driven the economy by really two things: how the consumer is faring, and then also how businesses are doing. When we look at household balance sheets are in a very strong spot. We see improvement in labor, and we see people with more money in their pocket today than previously. So disposable income is very good. Consumer sentiment is very strong. So people are looking to spend money. There's a lot of demand in the economy. And then businesses are also doing well from a fundamental perspective as well. So when we think about things like household surveys or leading indices for businesses, corporate profit growth, as Ben mentioned. We'll go into that a little bit more. Consumers and also businesses they're both in a very strong position. So when we see both of those happening, it makes us very bullish on the economy. It doesn't mean that the stock market must go higher, but we believe that the economy is very likely to grow not only this year, but next year as well. So it's not just a kind of a sugar high from where the economy is from 2020, but we think this has legs. This is a multi-year expansion. We touched on some of these bullet points already as far as Omicron being a near-term headwind, but when we look through, we get other items that might come into play. So inflation is certainly a big thing, right? Inflation came in at 7% last year, right? And you see it. You see it when you go to the grocery store. You see it when you fill up your car at the gas pump. It's really all over the place. And really, there's two big factors there. First off, I just mentioned that the demand, people want to go out and spend money. That's one part of it. The other aspect is there's issues with respect to some of the supply chain bottlenecks. And Ben had that heat map a moment ago. COVID is still a big issue overseas. So there are many issues in, say, China or Vietnam where the factories might be closed or the ports might be closed. So we're not getting enough goods coming over from Asia to the U.S. The U.S. has some issues with some of the ports, and then we also have some shortages with respect to not enough truck drivers in the country. So we don't have enough supply in the economy to meet the demand. That's really the main source of inflation. It's really quite different from 2008, where 2008, we had enough supply in the economy, but people were really just cautious to spend. Now it's the reverse. People want to spend money and buy things, but there's just not enough out there to buy. So that's why we see some of the prices that we see in the economy. That probably continues for at least another 6 months. We think inflation probably moderates as we go through the rest of this year and next year. But I don't think that we're going to see another 7% inflation this year. We're projecting somewhere between a 3 and a 4. And then the last items on this page here has to do with interest rate policy and the Federal Reserve with potentially a rise in interest rates. Very simply, if you think about the savings rate that you might get at your local bank, whether it's your checking account or your savings account, you hardly get anything. It's peanuts. The interest rate has been on the floor for the past couple of years. That is very likely to move higher over the next year and probably into next year as well. So markets are going to watch what happens to the interest rate environment to see how that affects both corporate borrowing as well as corporate savings as we go through the next year or two. When we look at it from an investment perspective, and let me just flip forward to the next slide here. What does that mean for stocks? What does that mean for bonds? How do we manage a portfolio? Well, we saw some positioning in a previous slide. So first off, we still like stocks relative to bonds. And when we think about that, even in an inflationary environment, if you have a bond and you get a coupon and that's 2%, 2.5%, 3%, you get that same 2.5%, 3% every year. You're pretty much stuck with that. In a stock, let's say you have inflation, management can do a handful of different things. Management might be able to raise prices and pass along some of their higher input costs. Maybe they find a way to operate more efficiently. Maybe the management of a company finds a different channel or a different way to sell their goods to the final end consumer. So there are things that management can do to make the ownership of stocks more valuable. So we certainly like stocks relative to bonds in this environment. We still like U.S. stocks relative to maybe Europe or Japan. We think the profitability outlook is much, much stronger in the States. And then on the bond side, I know Ben mentioned it earlier, but plain vanilla bonds really just don't do much in this market. In a strong economy where credit is still strong, we don't really see banks going out of business or people not being able to pay their loans. So having a position in higher yielding bonds makes sense here because you get a higher coupon, which helps to offset any rate increases on the price. So high level perspective, we like the economy. We like stocks relative to bonds. We like U.S. stocks relative to international, and we like high yield relative to investment grade. As we move forward here, the other slide I think is helpful to show. This is our speedometer slide. We publish this every month. And it's our outlook for the economy. And I know we spoke to a little bit already, but it's very easy to see green, yellow, or red. What does City National Rochdale think about the economy? And right away, you can see it's mostly green, right? This is a bullish outlook for economic growth. We think the economy grows anywhere from 5 to 6% last year, and probably 3.5 to 4.5% this year. And you can see the consumer lines on the upper right, and in the middle, consumer spending, those are all green. And then that third row where it says business outlook, leading indices, corporate profit growth, all very green and to the right. And from there, I do want to show one more slide on volatility because we've seen some choppiness in the markets, especially this year. So what we have here is a slide over the past, call it 40 years. And we have how each year did in the US stock markets, and those are the bars. So for example, we start with 1980. If you invested on January 1st in 1980 and stayed invested for the entire year, you had a return of 26% in the US equity markets. However, it was a very choppy road to get there. At one point in time, you suffered a minus, I think that's a minus 17, that red dot there. So if you were able to stay invested the whole time, you had a plus 26, but you had to stomach a minus 17 along the way. And you can see there have been a lot of times where you've had these red dots on the page where you've had a lot of drawdowns. Last year, we didn't really have that drawdown. If you invested January 1st through December 31st, you had a 29% return in US equities for the most part, if you just kind of did a plain vanilla US equity portfolio. And you only had to be a minus 5 at one point during the year. You know, fast forward to 2022, we're 3 weeks into the year and we're a minus 5 or a 6 already, right? So I think it's going to be a much choppier year this year, especially in the face of higher interest rates. We're still expecting, a positive year. If we had a plus 4, 5, 6, or a 7 by the end of the year, I'd be happy with that. I don't think that we're going to get the 10, 15, 20, 30% returns that we've had in previous years. I think it's going to be much more moderated on a go-forward basis. And I also think it's going to be a much choppier ride to get there as well. So let me pause there. And I think we've got some questions that maybe have come in.
We do. The first question we have here is, what are the effects of inflation going to be on the stock market in 2022, both domestically and internationally?
Right. It seems to be the topic that everyone wants to ask about, right? The three topics are Omicron, inflation, and interest rates. So inflation, we kind of spoke to it a little bit on a lot of demand, not enough supply. What does that mean for the market? Well, first off, it means that companies can charge more. And the reality is consumers, whether we like it or not, are probably in a better position to pay higher prices. So I think we're going to see some prices pass through. The stronger companies are going to be able to pass along prices better than maybe some of the weaker companies that are out there. And we differentiate when it comes to client portfolios. So I want to be in stronger quality companies, companies that are able to have profitability of 10, 20, 30% every year and are able to grow their profits and can do that in the face of inflation. Companies that are not profitable right now, those are the ones that are really kind of weaker. And you see the stock price is really reflecting that. So you think about a company like Fastly or Peloton or Spotify or Uber. I use all of their products. I like all of those companies' products, but none of them are actually profitable. And all of them are down meaningfully both last year and this year. And you see that really, inflation can be part of it and rates can be part of that as well.
Sir?
One thing I'll add to that is, we're investing. Inflation is real. It is here. We're feeling it every single day and we're investing according to that. But when you break down the components of inflation and you look at really where it's coming from, it really explains why we feel it the most. It's coming from the areas that we feel every single day. The biggest components of inflation rising right now are the price of food. So on the shelves in the grocery stores, we feel it. It's the price of fuel to fuel our cars. And then also in the transportation side, as we all know, it's the price of used cars and the supply of those. So transportation and food are the two biggest components of inflation that are spiking. And it's the ones that we as consumers feel the most every single day.
And Nick alluded to this earlier. The shipping costs that are associated with a company shipping something from overseas. Yep. That fuel spike is felt on their balance sheets. Okay. So that's also contributing to the inflation that we're experiencing this time. So it's as Ben just said, it's here, but the consumers might be in a position to be able to stomach this for at least not necessarily a long period of time, but in the short term, we should be able to pass this through.
And Dean, you also mentioned internationally too, inflation is not just a US phenomenon, right? We've also seen that creep up in other nations as well. It's part of the other reason why we would rather have some of the US companies relative to Europe, because we think they can stomach those and be more profitable through them. Best example is US has a bigger technology and communication sector.
We do have another question here, kind of in line with the hot topics here. Interest rates are finally starting to rise. At what point should we start to worry? In general, is a rising interest rate period good or bad for the markets?
So I think for that question, we have to step back and think, why are interest rates rising? Interest rates are rising because the economy is doing so well and because inflation is starting to creep up. If those factors were different, I would have a different answer for you. But I think that's fine, right? The economy can certainly take interest rates moving up over the course of the next year. And as long as the economy is continuing to expand, consumers in a good spot, corporate fundamentals are also in a good spot, they can handle rising rates. So from an economic perspective, I think that's a perfectly okay thing to have rates start to move up over the course of this year and probably next year as well.
So would you consider that maybe a lagging indicator? So where we are from a comma?
Potentially. That's one of those where ask three economists a question and you might get five answers from them. But I don't know that that's a meaningful headwind for either the economy or the markets right now.
This is good. We have a lot of questions here. So moving on to the next, what are the geopolitical headwinds that we should worry about, specifically Russia and China?
Yes. Yes is the short answer. So earlier we showed the speedometers that we have every month, and the one that actually moved from last month to this month was geopolitical. And it moved kind of from center yellow to center left. And historically, that's kind of been either red or yellow over the past number of years. And it's really China, Taiwan. That's been the number one reason why we have some concerns there. And then the other one is obviously Russia with Ukraine. And there's no doubt in my mind that those two are not independent events, right? The fact that Putin sees a little bit of saber rattling with China and Taiwan to be able to have a military presence outside of Ukraine, that's not a coincidence to me. So that's something that we watch. When we look at the individual companies that we invest in, one of the criteria for our research team is where does the revenue come from a geographical perspective? Is it all in the US? Do companies have revenue coming from overseas? Is it Europe? Is it Asia? We don't want to be too far exposed in one region of the world in case something like that does flare
up. Moving on to the next question. As far as the government spending, I will read verbatim. Do you think the $2 billion government spending spree, should it ever be approved, will have a positive or negative effect on the markets moving forward, in both this year and moving forward into the longer term as well?
Right. So I think there's really two parts to that question. One is we had the infrastructure bill that already went through. We think that will be additive. When you have bridges and broadband, laying those foundational aspects, I think that is additive to a GDP perspective. The newer bill kind of depends what comes through, right? Because some of it is climate change related and some of it is pre-K. It's yet to be seen what actually passes through. I think that's a harder one. I think if it does some of the things that we have to be mindful of, well, how does that impact people from a tax perspective? Do we see higher taxes and where are they levied? Is it at the consumer level or is it at the corporate level or both? And there's a lot of kind of infighting in DC to see what's palatable to pass through and what's not. And then the other is I think we might see higher energy costs if there's more of a greener movement. I know a lot of folks like the climate change issue, but we have to be able to stomach potentially paying more out of pocket at the gas pump or for fuel prices.
Maybe Nick takes a break here and we pass this one on to Ben. What are the best asset classes to take advantage of in a rising interest rate environment, typically, in moving forward into 2022 as well?
Yep. So Nick hit on this a little bit in terms of the types of companies that we're looking for in a rising rate inflationary environment. We're going to get into those higher profit margin type companies, more of the technology sectors, more of those types of growth-oriented names. But I also see the second part of the question is asking about bonds as well in a rising rate environment. So as many of you know, in a rising rate environment, there's an inverse relationship between bond prices and interest rates. So as interest rates rise, bond prices generally go down. Right now, where yields are, and I think we hit this a few times, but it's worth reiterating, your plain vanilla government high quality bonds really aren't paying a whole lot. When we look at our investment strategy, unless a client needs that rock of the portfolio, or it's a part of the portfolio that's come over that we're working out over time, we are not investing in investment grade plain vanilla bonds at this point in time because of that. Now, the other part said, should we be buying, selling, holding? It's a multifaceted question. It matters what part of the bond market you're looking at. As we've talked about already, there are some great opportunities in higher yielding credit at this point in time, and it's an area in the markets that we favor going forward, whether it be US or also internationally. There are some opportunities. When we look at things from an investment standpoint, whether it's the interest rate environment, the inflationary environment, the real question is where are we going forward? And there's risk involved in all of these investments, but the question is, and where we take our bets is, where do we believe the client's going to be compensated for that risk? And right now on the credit side, it's higher yielding credits, more corporate oriented credits. It's some emerging market debt that we're looking at that pays a nice higher coupon or yield versus the risk that we're taking, where you are taking on incrementally more risk. But given our research that we're doing and given the fundamentals, we can say with confidence that you're being compensated for that risk. Nick, I don't know if you have anything to add.
Yeah, I think that's right. That's the right way to think about it. Is the fixed income universe is huge, and there's parts of that market that we don't think we get compensated for that risk. Whether it's mortgages, autos, bankruptcy workouts, it's not really where we think there's a good risk reward. We like U.S. bank loans, European bank loans, U.S. high yield, maybe a sliver of emerging market debt. We think that makes sense, and we think that's where we can get an achievable yield without adding too much risk. We think that's a prudent risk reward there. So I like those areas. And then as that evolves, those areas might be different a year from now than where they are today. So we're always looking at that marketplace to see what makes sense for client portfolios and where can we get that return without really getting too far over our skis from a risk perspective.
From an implementation standpoint, the final thing I'll add is the one trick about those markets when we're talking about European bank loans, we're talking about emerging market debt. There are only certain ways you can access those markets. So implementation is really important. We would never recommend that any client go out and buy a single or a handful of European bank loans or some emerging market debt issues out in local currencies and in local markets. It really depends on active professional management to access those areas, whether it's through ETFs that are available, mutual fund strategies that are available, or professional management like we would provide at City National Rochdale.
This is very good. The Q&A keeps coming in, so I will go ahead and take this question. The question here is, what are you currently advising your clients that are 1 to 2 years away from retirement, as well as those that are currently in retirement? Is there any specific strategy?
Yeah, maybe I'll start that one and then I could kick it over to you, Nick.
Let me start, and then I'll kick it
sure,
over to you as well.
absolutely. Yep.
So one of the things that Nick and Ben have discussed earlier is a focus on quality. Quality investments are paramount when it comes to focusing on the distribution phase, specifically large cap companies that are paying a strong dividend, that have been doing it for a long time. 1 to 2 years is kind of, I want to say, a little bit on the late side to start to implement diversification. But as we do approach the retirement years, one of the things that we are advising is starting to get a little bit more conservative and focusing on the income generating asset class, which would be a combination of high yield, quality bonds, quality companies. And then also there are other instruments out there that are insurance based that can provide you with some protection component to the portfolio as well. In this yield starved environment that we are in, when we have new issued bonds floating around maybe 2 from a coupon rate standpoint, if we're looking at municipals that might be lower, these products do provide you with the same type of downside protection with the upside of the stock market as well. So if you have specific questions on that, we can certainly get you some more information, how it might make a portfolio certainly less risky in the long term. So please feel free to reach out. We can get you more information on that as well. and how we might reposition the portfolio slightly to utilize something in that sector. So, if you want to
I think
expand on that.
just expanding on what Dean just said, one of the benefits of an independent financial advisor is they have access to many, many products. We're just one of many money managers and products that they use at Flagship. So in terms of using us with some insurance products and numerous other things, you're arriving at a complex strategy that suits each client well. When we look at personalizing a portfolio, it really starts with defining the objectives. When we look at our clients in retirement, there are typically three key objectives. It's your paycheck throughout retirement, which is the income and the cash flow from the portfolio. It's really protecting your nest egg for all of our clients, even though they come from different ways. When we talk to them and learn about them, one thing that's common is that they believe that capital preservation, especially in markets like we're in right now, is as or more important than pure upside and capital appreciation. And then typically that third is legacy, if there's some legacy goals. If we can grow that portfolio, get you your paycheck through retirement, and have something left over to pass along to future generations or to charitable needs, whatever it may be, that's what we're trying to satisfy. I'll let Nick get into the nitty gritty, but Dean hit on the main points. It's find cash flow generating investments. Right now, because plain vanilla bonds are yielding so little, we have tilted a lot of our strategy to the steady, repeatable, dependable dividend payers as a part of that cash flow strategy. We're looking in the diversified areas of the bond market outside of those plain vanilla bonds. And where appropriate, we will take some growth exposure on the stock market, but it really is client specific. And the final thing I'll mention, that is why we don't take clients directly. And we always work with Dean and Joe and the team at Flagship Financial, because the planning that they do from a financial planning standpoint is the most important step in the process. That leads the way. They are essentially teeing everything up to tell us, here is exactly what my client needs. Here is their time horizon. Here are the other products we're using with that client. And then because we're not bound to a model or we're not selling a mutual fund, we're building a personalized strategy that plugs the holes that are necessary at that point in time. Nick, I don't know from a portfolio construction standpoint if there's anything else you wanted to point out.
I think you guys really nailed a lot of it. I'll just say, kind of from a personal perspective, from my view, I think a majority of the clients who we work with on the City National side are probably within 5 years of retirement or are in retirement already. And I know Dean and team, they're specialists in that area too. So there's definitely a good teamwork here as far as how to approach it. I like the high yield bonds. I like the dividends. It's nice to see the consistency of the cash flows, and especially when you own the individual securities in your name, in your portfolio, that cash flow is always generating in the portfolio for you. So the consistency is nice and strong.
One thing I'll reiterate to any investor out there, it's not necessarily the size of the dividend. It's the consistency and the repeatability of the dividend that's most important to us. So as an investment team, if we see a business that has been very predictable from a cash flow standpoint, but we see some turmoil, that their cash flows are going to become less stable, we're going to get out of that name, because it's that stability and that predictability that's most important.
Thank you. One of the other questions here is really commodity driven question. Can either of you expand on why gold and platinum and other commodities have been kind of going on the rise as of the recent couple weeks here?
It's been interesting there. As far as commodities in general, all of them are going to key off of a couple of different factors depending on what it is. You think about platinum and silver are more, they have inflation, but there's also a little bit of an industrial use case for them. When I think about gold, gold is more longer term, usually aligns more with kind of the real rates. So kind of keys off of both rates and inflation concurrently. So usually you hear of a lot of folks in the financial press say, well, if inflation's going higher, you want to own gold. That's true if rates aren't going higher. Inflation could go up and gold could go down if rates move higher than inflation. So I think you have to look at really a lot of different factors all concurrently. It just doesn't happen in a vacuum. And then the other thing that's really a little bit different today from maybe 5 years ago, 10 years ago, specific to gold, is a lot of people like to use that as a kind of a safe haven. And I think we're seeing a lot more kind of in the crypto space, right? A lot of people are saying, well, I don't want to own gold, I'd rather own Bitcoin. But all of those, from our perspective, they're a little bit more speculative. It's not like we can find a company and we can figure out predictably what their cash flows or what their operations are going to be over the next couple of years. I couldn't tell you where gold is going to be over the next year or two. It could be higher, it could be lower. There's a lot of uncertainty in these markets. Certainly. I don't know if you want to add anything to that.
No, I would just, the last point you made is the key. How do you value it?
Yeah.
And where do we see it going forward? Especially on the crypto side, a lot of our clients come to us and say, you know, are you investing in crypto? It's something that we're tracking closely. We want to really gauge the impact of crypto is going to have on the economy, on the companies we're investing in, et cetera. But at this point in time, the speculation, the inability to value it on a forward-looking basis, it's not a right investment for our clients as a core part of the portfolio.
And I know we got kind of a little bit off topic of the gold, but just one more item on crypto is if you think back to the gold rush, right? Back when everybody went west, you know, a lot of people, some people struck gold and a lot of people kind of struck out, but the people who really made the money were the ones who sold the pickets and the shovels and the buckets. Kind of the same thing with crypto. I'd rather be investing in some of the companies that help to supply some of the computers and some of the miners. I'd rather be in some of the companies that are more profitable from the trend than just trying to speculate on the trend itself.
That's a great point. That's a great point. We actually do not have any further questions here. I guess what we'll do is we will leave it open for another few minutes before we have some closing remarks.
Absolutely. They're great questions.
So if anyone wants to take advantage of picking any of our brains, please take advantage now. Just sit here a few minutes.
I think that might be it, but for everyone who attends, Dean and the Flagship financial team have full access to us on a daily basis. We talk regularly. So if you're digesting this and you have some questions that pop into your mind afterwards, or you're replaying some of the things we talked about, definitely let them know. We'd be happy to speak to you, answer questions in any form you'd like.
Well, again, I'd like to just thank both of our panelists here for joining us this evening. This was great. We answered a lot of great questions. We appreciate both of you tremendously. We appreciate the partnership. We want to thank SEI again, and I would like to personally thank my team, for helping to put this together and being a part of it. Without you guys, each and every one of you, we would not be able to help all of our clients in the ways that we do. So I just want to say thank you to everyone. Okay, great. All right.
Thanks everyone for joining us.
Thank you for joining us. Have a great night.